Hi, it's Mark from Top Local Lead Generation. We're here with John Nieuwenburg of W5 Coaching in Vancouver, one of my favorite human beings in the world. How you doing today, John?
Awesome, after that kind of an introduction.
So we're going to talk about how often should I get a financial report from my accountant or bookkeeper. How does that work?
Well, most of the time business owners really don't have a very good understanding of what they should be asking for from their bookkeeper accountant, and the bookkeeper accountant only delivers just what they're asked for. And in my view, what that typically is very much underserving the needs of a client. So typically a business owner says, well, what do I need to get in order to stay on side as far as taxes are concerned? And that generally means that they're going to get a P&L and a balance sheet, a profit and loss statement, and a balance sheet, and they're going to get that once a year, and that's the basis on which they'll do a tax return, which is not nearly adequate. Your ability, your success as a business owner is scored by a score is kept by the quality of the financial results you're able to obtain. So, as a business owner, we get some kind of remuneration or payback or satisfaction because we're doing work we love, or we're making things we like to make, or, it's satisfying to run your own ship and those kinds of things. And there's lots of reasons that we have our own business. But at the end of the day, the ultimate scorecard is your financials. And your financials then, in effect, are a little like the equivalent of going to a professional sporting event and only being shown the scoreboard at the 60-minute mark. That's the equivalent of what business owners. So imagine going to a hockey game. There's a bunch of activity that takes place. We start in the first minute, 60 minutes later. That's the first time we're shown the scoreboard and the first time that we get to make a decision about whether or not the results are good. Obviously, that's not adequate. So at the very least, you'll want to get your financials monthly, no more than 9 days after 9 days after the end of the previous month. So 9 days is a bit arbitrary. It could be 10, but that there is a specific date by which you're making a judgment about how well you made decisions in the previous month and what adjustments, if any, you need to make. So a balance sheet, let's go through the three primary reports. A balance sheet is the equivalent of a still photography. It's a specific point in time, and it is a document that helps record on balance what is the balance of assets versus liabilities. That's why it's called a balance sheet. And 12 months later, if you were to look at the balance sheet, you'd want to make a judgment. Did this balance sheet improve? I've got a bit of a presentation. Maybe I'll just walk through it. Can I screen share here, Mark?
Absolutely.
So I'm going to screen share. And let's go through this. And are we looking at a thing that says things and stuff?
Yep.
All right. So what we owe versus what we own, that combination has to balance the things and stuff. This is the assets of the company. So in this particular case, the company's year starts in September and its year end is in August. How did we get from here to there? Well, we do a thing called a P&L. So a P&L is equivalent, if a balance sheet's like a still photography, a P&L is like a movie. It's a video of all of the decisions, decisions that we made that took us from September through August, and the second part of which is the statement of cash. So let me make a distinction here. A P&L is a document that says if all of the assumptions we made about the accounting is correct, here's how much profit or loss you would have made in this period. For many reasons, what it says on the P&L may or may not actually appear in your bank account. So there's things like depreciation and amortization that are non-cash events that happen that may or may not be reflected in the amount of money that you have in the bank. You also have things like accounts receivable that if you're not collecting, it'll show up as a profit in your P&L, but you don't have the money, and so that's what the statement of cash helps us understand. How much money is there actually available for you to spend in the business? So often bookkeepers will give a balance sheet, and they'll often do a P&L, but 95% of the time, in my experience, they don't produce or prepare a statement of cash. So let's walk through an example of in September, we owned a house for $500,000, and that's what we see on the left-hand side here. And we owe $400,000 in the form of a mortgage, and we own as an asset $100,000. So 12 months rolls by. Where are we at today? Well, 12 months have rolled by, and now the things and stuff, the house is now worth $550,000. And that's because the market grew, and so the value of the house grew from $500,000 to $550,000, and we also paid off $50,000. So the $50,000 we paid down plus the $50,000 the market grew means our equity is now $200,000, and our mortgage is $350,000. We paid it down $350,000. The equity grew by $100,000, but that was in part because the value of the house grew. Now, how did we make these decisions? Well, we had a bunch of activity that took place, but on the statement of cash, we'll see an occasion where we took $50,000 out of the bank and put it onto this mortgage, and thereby increasing our equity. So this is the short version. I'm going to stop share. That's the short version of the 3 documents that you should be getting from your bookkeeper accountant. Now, I've given you kind of a really thumbnail kind of sketch of what the 3 documents are, but here's what I'd like you to think about. Let's say today is nearly the end of July, and so August 10th, I expect a business owner to get a set of reports from their accountant, and that set of reports should help us think about, was July a good month or a poor month, and to what extent should we alter or change or modify our plan so that we get a result that's better than the result that we might have gotten for July. And if you're only doing that once a year, it's the equivalent of a pilot flying on a navigation plan that whose computer only checks with the navigation plan once every 1,000 miles. And how well do you think that's going to work out? Is there any chances that the breeze, the winds, and so forth have pushed you off course, and now you're so far off course, and this metaphor could go on forever, of course, but now you're flying below 10,000 feet and there's a mountain in the way and you don't even know about it. So the bottom line to all of this, and maybe I haven't been as clear as I might have been, is that if any of this sounds like Greek to you, and you know that you should be better about how you manage the financial records and the financial decisions in your business, then perhaps you'll want to have a meeting with me, with a business coach, or perhaps you'll want to show this video hangout to your accountant and say, what in the world is he talking about and what does it mean to me? Mark, that's my thought of the day. How often should you get financial reports? You should get them at least no less than monthly.
So if that made sense, great. If that didn't make sense, give John a call. You can reach him, or you can email him at john@w5coaching.com. Check out his website. Tons of information, including, I bet, some stuff about this, w5coaching.com. One of the best coaches in North America. Thanks, John.
Cheers. My pleasure. Thanks, Mark.